Friday the 21st. Good morning from London. This is Bloomberg Markets Today. I'm Guy Johnson. I'm alongside Kriti, Gupta and Tom McKenzie. Anna is off today. Cash trade around an hour away. That's for equity. So what do you need to know this morning? Fresh PMI data from across Europe will be in focus this morning. We're going to bring you the data and we're going to bring you the analysis. UK consumer confidence rises. Retail sales data is expected to do the same. It's about to hit your screens. And the Bank of England might be about to cut rates. Is the feel-good factor finally about to arrive in Britain? And as Bugatti unveils its $4 million, 1,800 horsepower hybrid hypercar, the Tourbillon, we are going to hear from the company's CEO. Mr. Rimac is going to be joining us. Rimac Mates is going to be coming up a little bit later. Kriti.
Quick check on these markets. You are seeing kind of a flat reaction in equities right now. Your stock 50 futures, like I said, 49.49 is where we're at there. But the real action seems to be in the currency space. Euro dollar 107.17. Cable actually popping on these numbers. We're going to dive into it. 126.68 on the pair. Markets today starts right now.
Is the feel-good factor about to arrive in Britain? UK consumer confidence data is improving. We've got retail sales dropping onto the screen right now. They are much better than anticipated. Did Rishi Sunak call the general election a little too early? Because apparently the Bank of England could be about to cut rates as well. Let me give you the numbers. Retail sales, this is the including auto fuel numbers, i.e. includes petrol. That number is plus 2.9. That comes up from negative 2.3. We are back spending. The weather is better. And apparently that makes a difference. Other numbers, ex-fuel, 1.3%. That's up significantly. The data are good. Even the previous numbers, guys, are revised higher. Are you feeling better?
These numbers are a solid beat, aren't they? And they come on the back of the consumer sentiment survey that you said coming back to levels we haven't seen since November of 2021.
Still negative, but better.
But better, getting there. So the cost of living crisis, it seems, is starting to ease. The Bank of England is suggesting there's going to be a cut in August. You can't help but not tie in the politics. You talked to this, whether or not Sunak has made. There was that big question. Did he make that mistake in not leaving it later? The economic data is starting to look a little bit better here in the UK. And then you could get that cut coming through from the Bank of England in August.
You asked if I'm feeling better, and the answer is no, because I'm waiting for the sunshine to be more persistent. And I think, isn't that the big kind of piece of the data?
This is as good as it gets. I just want to flag that for you. This is the British summer. It's going to last 2 weeks. The Finns, and I think the Swedes and the Finns today, it's the longest day of the year, yesterday or today. They're out today. They're soaking up the sun. This is as good as it gets.
This feels like a ripoff. I was promised the summer in London is the best.
Texas.
I know, but I was still promised the summer in London is the best time of year, and I'm just going to say producers on this team assured me that was true. We're going to see if that lasts. In terms of the data, though, we'll see if it shows up, because if you do have rainy weather was such a big part of the last couple of data prints, right? I mean, surprise, surprise in London at the end of the day. But I think it's an interesting point that you're seeing cable pop off the back of the data. 126.68 is where we're at on that pair. Strength in the pound seems to be a pretty consistent theme that we've been seeing lately.
What is peculiar about this is that you have an economy that's recovering, but the Bank of England is talking about cutting. And this is something we don't normally see in economic cycles, is it? Normally, what happens is the economy rolls over pretty hard and the central banks are forced to cut. This time, inflation is coming down, therefore central banks can cut. And that's a very different kind of kettle of fish.
The revisions are also lower as well for the previous month in terms of improved, I should say.
They're better.
Improved. So the contraction that we saw in the previous month, less severe than the initial numbers that come through. So there's that as well in terms of what's happening with the retail sales. To what extent is the consumer here able to continue to feel that recovery if we do not get a further cut? We have still homeowners refinancing as well. That's been something that's been cautioned. There's still a big chunk of homeowners refinancing in this higher rate environment. Is this a weather factor? Is it the boost coming through from the sporting season? Are we starting to get into that? Certainly not as a result of yesterday's game
last night.
But is this sustainable? Essentially, if we do not, do we need that cut to come through in August from the BOE
to keep
this going?
I don't know. It's a good question. I think the weather would certainly help. The football would be an improvement too.
Did you watch the game?
I did watch the game. It started at 5 o'clock. I can watch it before my bedtime.
That's 90 minutes of my life I'll never get back.
It was really boring, wasn't it? And they weren't very good.
It was like, it's like a team. Every time we're told that we have the best players, and they perform in the Premier League, and then they perform like they're playing for Luton FC when they're on the big stage.
As they pointed out at half-time, they're playing a different format. It's the strong push you want to... Anyway, we digress. Let's talk a little bit about what is happening with the PMI data. I'm quite excited about this PMI data because, again, this goes to this idea that actually what you are seeing potentially, and we wait to see the numbers, is the inflation story beginning to abate. So watch the prices paid components in all these numbers, but potentially a better headline number. And that's the Goldilocks scenario. That's the kind of the perfect print.
Does that keep the ECB on hold for longer if you get that Goldilocks scenario?
Maybe. Maybe it feels like they are edging towards a second cut, but being cautious. I think it almost feels like the ECB wants everybody else to catch up.
I'm kind of waiting for the ECB, and at least some of the ECB speak that sometimes hits the wires to address some of the political turmoil as well. And I haven't actually seen that happen. I know they're supposed to be separate in theory, but still, even when there are geopolitical tensions with China, for example, the EV narrative ramping up, or when there are deficit concerns, when you have warnings coming out of the IMF, for example, there tend to be some sort of comment from central banks.
There has been some. So I've heard the Bank of France governor talk about the fact that he's concerned about the deficits and that you do not want to push those any further, that he's concerned about what is happening on the fiscal front. I've heard other central banks talking about the fact they don't see any concern around France yet. But that's about as far as it goes, to your point.
That is as far as it goes, but that's the problem, isn't it? I mean, maybe I'm missing something here, but if you have these deficit concerns and you have this widening yield spread that everyone's not even taking advantage of, which we saw with the bond auction on Thursday as well, it's important to keep in mind that at what point do people have to start thinking about further euro weakness? Remember, do we reintroduce parity as a more prominent theme? I imagine we'll talk about that in our next segment with our FX guest as well. And how long does that last, especially going into a pretty turbulent 6 months post-French elections in terms of global geopolitics?
Top story this morning that I'm reading, Le Pen's rise sets up French debt market for years of pain. That's the narrative that we're basically talking about here. But it's interesting that Le Pen is being perceived as being the kind of the obvious next story in France, that Macron is... You look at the Harris poll that came out yesterday, still ahead. Le Pen is being perceived in Brussels and elsewhere as being the obvious candidate to win this election. So
the connection I'm making here, and I'm trying to find the apt parallel, is when you see in the BOJ, for example, stick with me. I'm going to do a little tour.
Going somewhere.
I am going somewhere. There will be a point to this rant. The narrative in the BOJ and the ECB and the BOE off of the sell-off in the long end of U.S. Treasuries back in 2023, in the third quarter of 2023, was talked about in every other major central bank meeting because it was impacting their curves. And even in the we talked about whether France is going to have a Liz Truss kind of moment in their markets. That had ripple effects into the Treasury market, for example. That had ripple effects into every other bond market. The read-through from what we're seeing in France and this widening spread isn't as big as I think a lot of people were expecting it to be. And that begs the question, is there a dislocation? Maybe.
Do you think the Fed would talk about it? Do you think Powell would talk about it? Powell goes about as far as saying, I think I'm concerned about debt sustainability in the United States. About as far as he'll go.
But that's because there's no read-through yet. If this gets worse, if you see a widening of spreads, if you see this deficit conversation continue, if you see an unfavorable result, July 7th,
unfavorable for the markets.
Unfavorable for the markets, right? Then that becomes a bigger concern for the Fed, and I could see them talking about some sort of reverse effect. He mentioned the guilt story when it was Liz Truss.
He did. It's nice to talk about somebody else's problems. What do we think about the Fed? What do we think about the latest comments? The data are softening, but the Fed certainly seems... The narrative I heard yesterday was we are going to stick to what we've suggested thus far, and that is that we need to be patient. We need to see more data. We need to see consistent data. We need definitely to see the trajectory moving in the right direction. We're not convinced we're there yet.
Does the housing story play into that? I mean, the data out in the housing market yesterday was pointing to the pain that's coming through as a result of rates at 525, 550. So that sector is starting to slow in terms of US home construction falling to the lowest pace since, June of 2020. That isn't a key data point for the Fed, but you're starting to see evidence that higher rates are now starting to have an impact and starting to squeeze parts of the job markets, parts of the jobs data, housing now under pressure.
Is it coming via the labour market? Is it coming via the labour market? The claims data yesterday would suggest no. But is there weakening in the claims in the labour market that's beginning to show up in the housing market?
And is there a level they're looking at? We're at 4% now. Is it 4.2, 4.3? Is that the moment? They have a dual mandate for the Fed.
It's a lot of eco data that they have to process. I'd argue they're also having one eye on the stock market as well. As you continue to see green on scene, you see financial conditions ease as a function of the rally you're seeing in U.S. equities. There is a case to say, well, maybe we push this further out. James Bullard, the known kind of I want to say pundit, basically, on the FOMC.
He now is a pundit.
Yeah, but not a voting member. Former St. Louis. St. Louis.
Oh my Lord! How long have we had you here?
I know. I admit,
Missouri. I know how to say that.
I know Missouri is not my strong point in terms of the states. I'm also struggling. It's a Friday. Leave me alone. The projections only show one cut. The market shows two.
Yeah.
Bullard saying that, look, this is going to be 2, and that's already a pull down from 3 as well. I wonder to what extent he's keeping an eye on financial conditions, and that even pulls back even further.
Bullard's being replaced by Kashkari.
Yeah.
In terms of the hawkish kind of
narrative.
Bullard goes, Kashkari seems to take over.
Yeah.
Kashkari still sounds pretty hawkish to me. So there is still I think there still is a kind of feeling of the fact that they want to wait, and that was the message that we got yesterday. And the centre of gravity still feels it's to the right of the curve rather than the left of the curve in terms of kind of where we're going with the dovish story. Let's talk about what we're going to be watching for the rest of the day. There's 2 things. At the moment, barring any surprises, 2 things you want to watch out for today. There's a bunch of PMI data coming out. It starts in Europe, goes to the United States a little bit later on. The other one, of course, is the volatility that we could be seeing a little bit later on with triple witching. That is something that I do think we want to pay attention to today. The market's just getting bigger and bigger. The options market's getting bigger and bigger. The effect is getting bigger and bigger. This time feels maybe it's going to have maybe less of an effect, but there is the potential this afternoon for a little bit of volatility in these markets. There's an awful lot rolling off, and kind of what do you do with that?
A lot of traders talking about this triple witching being kind of the point where you start to see a potential trigger for a bigger sell-off, especially going into the weekend. Of course, they're kind of made to say that, aren't they? Yep. I have a fun fact for you guys. I think Tom will appreciate this one on NVIDIA. It's coming out of SIBO, so they're also the index behind the VIX and all of that. They say that NVIDIA option volume yesterday topped 10.6 million contracts. It's the first time a single stock has ever hit double-digit millions.
Wow.
That's how much is going on in the options vault.
So you think about the gamma effect on that, which is absolutely enormous. And it's kind of self-feeding on a day-by-day basis. I was talking to Michael Masika about this the other day. The gamma effect, the positive gamma effects you're getting as a result of all these options that are trading around NVIDIA is enormous right now. You plug in the retail story, which is now getting bigger and bigger as well because of the split. And you've got 2 really positive forces. My question is, if it goes into reverse, you get that you get the negative gamma, and at some point that could really, if you do see a wobble in NVIDIA, how big an sort of effect will that be? I think will be really interesting to watch, because at some point there is going to be a wobble around NVIDIA. How
many times on the show have we talked about how cheap it is to hedge to the downside right now, because nobody actually is. But that, to your point, sets up the stage that if there is some sort of sell-off or some sort of mini correction, etc., it snowballs even faster for that very reason.
Because of the concentration risks around the Man Group of stocks.
Yes.
Man Group?
Well, yeah. Microsoft, Apple, NVIDIA.
Nice.
Yeah.
Well done.
No, it's good. It's good. I like it. The Man Group. I'm not sure we're allowed to say that.
There's also a hedge fund. So, yeah.
Anyway, for different reasons. So Stifel's out with a decent note, which they talk about the fact that the market could go to 6, you could see 6,000, but then you get a big move to the downside. You get a 20% move to the downside. So the sense seems to be this bubble still has the potential. I'm going to call it a bubble. People may disagree with me. You can write in. You can, if it is a bubble, it still has the potential to pull more people in. You take the market up towards 6,000, then things start to unwind.
You're channeling your inner Barry Bannister. I can see in terms of the downside moves there.
Or if AI keeps us going at these levels, keeps the rally and sustains that, then you come through with a cut from the Fed. And James Bullard, by the way, saying that September for him is open. Markets are pricing in November, December. He says September's an option, but then they go very gradually.
Some people
think
it's July, but okay.
July, 2 big bets on July. If they go July, let's put that to one side. If they go September, if they go November, if you've propelled forward with AI and then the Fed comes through with a cut, does that market rally start to broaden? Do you get the breadth that is needed? Is that the bull case for keeping exposure and maybe starting to build out your positions in some of those better value stocks?
Tom's taking the other side of the fence. Potentially that could be the story. The market has been very narrow and getting narrower. You need to see some breadth.
Coming up, Bugatti's new $4 million car is out. We're going to hear from the CEO of Bugatti Rimac. That is coming up. Plus, the rise of Paris as a finance hub. It could be at risk after President Emmanuel Macron's snap election gamble. We discussed that. Up next, though, how long the Fed's Neil Kashkari thinks it will take for inflation to return to target. He's pushing out a couple of years. We're going to chat markets next. If you have any questions of your our guests, please send them to us on IB plus BBTV Go. This is Bloomberg.
It'll probably take a year or two to get all the way back down to our 2% target. The good news in all of this is that the labor market has remained remarkably strong. Wage growth is still pretty good for workers. By some measures, might be still a little bit too high to get back to our 2% inflation target. So getting all the way back to 2% is going to take a little more time, but I'm confident that we're going to get there.
Minneapolis Fed President Neil Kashkari there talking about what the Fed's going to do next. He, of course, is something of a hawk. It's been amazing the transition he's gone through over the last few years. Let me just quickly show you what the dollar has done over the last 5 days, just to give you a bit of background as to our next conversation. As you can see, we're actually fairly flat on the week. Within Europe, though, there's some interesting trades going on, and this morning's data and the data we maybe get a little bit later on is going to maybe propel that story forward. Timos Fiatakis, Global Head of FX Strategy and EM Macro Strategy at Barclays Corporate Investment Bank, joining us on set this morning. Great to see you.
Very good to be here.
Perfect person to talk to. The UK data this morning looks good. You've just had GfK consumer confidence data out. You've just had retail sales numbers. Apparently, we're all going shopping. The Bank of England's about to be cutting rates. That may support that story as well. Where do you see the pound going? What's the story around the pound?
So we have been in the camp that the pound is undervalued and should appreciate this year. And we held that view even in a time where people were bearish. That sentiment now in the market is changing. I think, first, the characteristics of the UK economy, the labour market, have maintained, particularly for this year, a level of robustness which people didn't expect. That's fine. That's all good. But I think the bigger story underneath it all is that if you look at the pound, it has traded very cheap since 2016. Yep. This is because the market was probably wise in foreseeing that this way that we have exited the trade agreements with Europe and the rest of the world would create some supply shocks, 3 big supply shocks in labor markets, availability of product and price of product, which ultimately ended up being net negatives for the pound. These things, after the elections, regardless of the outcome, both parties are set to negotiate a closer trade relationship. Yep. And I think these things are set to correct. So the elections itself, regardless of the outcome, is a catalyst for some of that cheapness to unwind. And we see the pound against the euro declining to something like 80 from something like 84 plus.
Euro sterling.
Yeah, euro sterling.
Yeah. So Timos sits down. He goes, "I got this thing going on. It's called. What is it? Britain going back in again. What did you call that? Britain. And then we've got Frexit on the other side. Is that the trade? Is that how I want to think about this?
To some degree. It's obviously an exaggeration in terms because Europe, the UK is not going to go back into the European Union and France is not going to exit. But it is pretty clear that the politics are moving in the opposite direction. We're moving from a place where we had the prospect of a pretty bewildering exit from trade relationships with the rest of the world to a place where these things are normalizing in the UK, and that matters a lot for the pound, to a place in Europe where the risks, political risks, are becoming squarely a negative factor. And there are several ways that the France situation can become a negative factor for the euro. It's not a Frexit situation, and the market tends to focus a little bit too much on whether immediately after the election there's going to be an explosion of political risks, which we doubt. But there's a slow burn to the downside, which will bring ultimately France into a place of conflict with the rest of the EU, into a place of conflict with the EU institutions, into a place of friction on the Russia-Ukraine situation, and into a place where its own politics can become a contagion factor for other elections.
Actually, the better word there is friction. Maybe that's the way we need to think about it. Maybe it's not Frexit, it's friction. Maybe that's the way to go.
I think I should have called you before I put that title.
Yeah. You're just on a roll with the puns today, aren't you? So much of what you're talking about is a function of the fiscal policy, or at least what's been promised by some of these political leaders on both sides of the English Channel. Is deficit pricing a thing? Are the deficits in France, the UK, even the United States, something that even factors into the FX narrative right now?
A lot, but it's a lot more nuanced than just in the case of the UK, where the mini budget situation proved to be a pretty linear risk, or non-linear in some ways. For instance, in the US, what is not very well acknowledged is that a big part of the deficit, or some respectable part of the deficit, has gone into investments. It has fueled an investment boom in the United States, which you haven't seen in other places. So we tend to talk very lightly about the deficit in the United States, but it has actually been a positive factor, or it has triggered certain areas of U.S. exceptionalism that have supported the dollar. In contrast, the kind of deficits that we're discussing in France, particularly, and this is a big factor if polls start showing the left gaining some momentum, some of those deficits may not be the market may not be as kind to such stuff.
You were speaking Guy's language this morning. Guy loves to talk about fiscal spend in the States and even in Italy.
The supply side is so important because they're building a higher potential economy, which is kind of what you want to do.
Yeah, they've
been doing that for decades as well, right? They've become an oil superpower. They've lowered taxes to attract capital. Now they have the most comprehensive industrial policy they've had in years. There's reasons behind this dollar exceptionalism and why the dollar's been trading strong for nearly 12, 13 years now.
Which other currencies then benefit from the squeeze on euro? If you think the euro is going to go and come under further pressure, or does the premium around the debt story and the sovereign debt of France, is that a factor that keeps yields high? Is it a factor that supports the euro to some extent? What is your view on euro? Where do you cycle out? If it's not the pound, where else are you looking?
So in the very near term, you can have any election outcome create volatility in both directions for the euro. I'm going to take a step away from the day off trade price action. But I do think that if you think about the increasing risks for the medium term, euro sterling is a key cross we're looking at. The other currency that benefits is the Swiss franc, obviously, in this situation. It's the typical place where Europeans use as a safe haven. In contrast, this entire geopolitical situation hurts Central and Eastern European currencies, I would say, pretty directly.
When it comes to the yen, intervention once again, 160.17 is the level at which they intervened last time. Is there anything they can do? Does the sustainability of the intervention story for Japan when they have this rate differential? Where do you see it? I mean, do they just go through 160? Are they going to step in again?
I think that the path of the yen is weaker for a couple of reasons. First of all, it's not just the changes in U.S. interest rates or the direction of the dollar. We have shown in recent research that if you have a level of negative carry in the yen passively drifts weaker. So even if you intervene once or twice, the force of gravity is for the yen to go lower due to the size of that interest rate differential. We don't see that interest rate differential narrowing until the Fed starts cutting meaningfully, basically, next year. So that's one thing. Now, the intervention itself, we have seen the last intervention. They spent an enormous amount of money. The net result has not been something that has changed the trend. So, for us, it's much more of a volatility factor and something for someone to consider when they're looking at the volatility of the book, as opposed to something that changes the direction. Okay, the gravitational pull for the Japanese yen. Themis, thank you very much indeed. By the way, I'll just say Guy is still meditating on his friction line. He's very, very chuffed about that.
I'm happy to hand it over.
We'll see if it ends up in Themis's notes in the weeks ahead. Themis Fiatakis, Global Head of FX Strategy and EM Market Strategy, Macro Strategy at Barclays Corporate Investment Bank. Themis, thank you. Plenty more coming up. This is Bloomberg.
Britain's economy is under incredible strain, more than you may realise.
Austerity through to successive, extraordinarily expensive and damaging crises has left the UK with an enormous debt burden.
Compared to our friends here, or in fact in any major advanced economy, national debt in the UK has ballooned the most since COVID. But it's not just borrowing that's an issue. Look at tax revenue as a percentage of GDP. Basically, the share of the country's output that the government takes to pay for what the public needs. And in an election year, that's a massive problem for whoever's tasked with writing a new spending plan.
There's 1 million people, in a sense, missing from the labour force, many of them claiming disability benefit or sitting on NHS waiting lists. That represents a lot of missing productive capacity.
This is all monumental pressure for the next government to withstand and relieve. They need to get the population able to work doing so, and in a more productive capacity. Then there's wiggle room to deal with high interest rates and bring down national debt, freeing up tax revenue to bolster public services and support the people unable to work in the first place. Everyone agrees this is an enormous challenge, but if it's one a new government can pull off, the potential gains are massive.
A Bloomberg Originals report there on the economic challenges facing the UK's next government. Let's get more on that story. Our chief UK economist joins us this morning, Dan Hansen from Bloomberg Economics. In a commercial break, we were having a really riveting conversation about whether or not we were in a crisis or not.
Yeah.
Walk us through that. If we're not in a crisis now, will we be soon?
I don't think so. I mean, I think what Phil and Stephanie are sort of getting at there is the idea that prior to the financial crisis, the UK economy grew at 2.5% a year. Since then, we've grown a lot less than that. A lot of it is to do with productivity growth. We haven't had any productivity growth here in the UK. And there's also this issue that's come out since the pandemic where participation, so labour force participation, the number of people in the workforce has shrunk. So all of this, if you put it in the context of the next government and you think about fiscal policy, if the economy doesn't grow quickly, tax revenues don't rise. So it's very hard to bring down the deficit, bring down the debt burden. And in a world of high interest rates, that challenge is even greater. So what that originals is going to is the idea that if the government can fix the growth problem, there'll be more money to spend. I mean, that's no shock. We know that. The question really is, how do we do that? And I think there are a few things. It goes to a point about investment. It goes to a point about taking on new creative or destructive technology, so AI, things like that. And I think also political stability. That is a big thing. So I think those three things are probably the recipe. And we'll see what happens when the next government comes to power.
So it's interesting, Dan, you talk about productivity and participation as key drags for this economy, and then you talk about some of the solutions. You do not mention Brexit and a potential dividend that could come from closer partnership with the EU. Look, Guy's been speaking to the head of the Liberal Democrat Party. They have obviously a constructive view on relations with the Eurozone. Yep. Let's see how it all unfolds on July the 5th when results come through. They could play a pretty pivotal role post that election.
Yep.
In terms of our proximity to Europe as a potential ballast for this economy, how are you thinking about potential upside on that front?
Yeah, there is upside there. I mean, you are quite boxed in if you're going to say, forget going back to freedom of movement of labour, not going to a customs union. So those two things sort of box you in quite considerably. So you have to then sort of look at the deal we've got at the moment and try and pick things that will improve the deal. So regulatory alignment is a big thing that we could go for. But I think the key thing with all the Brexit stuff is that there has to be appetite on both sides for it to happen. And obviously there's a lot going on with France at the moment that's going to take the EU's attention. And I think the other thing is it just takes ages for these things to be negotiated. If you look at the deal the EU did with Canada, it just takes such a long time for these things to come through. So, yeah, there is some upside there, you're right, definitely. And if there was a big change, we would think, yeah, OK. But I think of the things that are on the list that should be most important and prioritised, it's on there, but it's probably not at the top.
Let's talk about the labour force for just a moment. It's a bit of a chicken and egg scenario, isn't it? Let's say immigration is something that no party wants to pursue at the moment en masse. Let's kind of park that. Let's assume that is assumed. Do you spend money on the NHS to get a more productive labour market, or do you have to get a more productive labour market to spend money on the NHS?
That's a really good question, and I think it's getting a more productive labour force first. And then to get
but how do you do that with that? A lot of the people that are out of the labour market are out of the labour market because of health issues, disability issues, etc.
They are. That's absolutely right. But I think it goes back to there are two parts of this. One is participation, so that's people in the labour force.
Sure.
And the other bit of it is making the people in the labour force more productive.
Yeah.
And it's that second bit, and that's sort of the answer to the first question that I gave. It's like, if you can get that working, if you can get the labour force that we have more productive, that will produce significant dividends, and that's where the tax revenue will eventually come from. There is a question mark, you're right, around participation. Some of it is to do with sickness, but some of it is to do with people retiring early as well. And that happened during the pandemic, taking early retirement, and that's to do with the way pensions work a little bit in the UK. And there's a question mark about whether you can really bring some of these people back. So whether that is a structural thing now for the UK, or whether it's something that we can look at and deal with. But I definitely think the answer to this is around productivity rather than focusing on participation. Productivity has been a long-standing issue for the UK.
Dan, just briefly on what we heard from the BOE yesterday, do you think August is have you moved your expectations? Well, you were always for August, weren't you?
Yeah,
in terms
yeah,
of
we
where
were.
So they've come round to your view. Finally.
Well done, Dan.
And what does that mean in terms of your outlook for growth? We're seeing the consumer pick up here. We get a cut in August.
So, yeah, you're absolutely right. They've come around to our view. I think I'll take that for sure. No, look, I think it was a little bit more dovish than everyone expected yesterday, the sort of idea of finely balanced for some members of the committee. But I think you're absolutely right about what's happening on the growth side. The economy is going pretty strongly and coming out of that very shallow recession we had pretty quickly. So I think they seem pretty keen to cut, and I think they will go in August. How quickly they go after that, I think, is a much sort of tougher question to answer. I think it'll be pretty slow. And that goes back to the economy, and that goes back to the economy keeping inflation sticky.
OK. Dan Hansen, thank you very much indeed. Chief UK economist from Bloomberg Economics with the insights there. Now, on Monday, UK Business Secretary Kemi Badenoch and Shadow Business Secretary Jonathan Reynolds will go head-to-head in a live televised debate moderated by Bloomberg's Francine Lacroix. They'll also face questions from Britain's leading business groups. Catch the business debate, 12:30 p.m. UK time, Monday on Bloomberg TV, plus the terminal, website, YouTube, Bloomberg, radio, everywhere else, essentially, as we, of course, count down to that election here in the UK.
Talking of elections, let's turn our attention to what is happening in France, where the leaders of the far right and the far left parties are trying to reassure the markets to a certain extent about their economic programmes. They did so at a hearing yesterday that was led by the French business lobby MEDEF, and as they were going in and out, they spoke, of course, to Bloomberg's Caroline Conan on the sidelines of that event.
I think you're the one causing the concerns on the markets in a pointless manner. We have decided to widen our majority because I think there is a real danger today to see Jean-Luc Mélenchon and the far left coming to power, which would make France like Venezuela without the oil.
The first panic on the markets was linked to the snap elections call. So go and ask Mr. Macron why he thought it was a good idea to worry the markets. I don't think our policies will worry them for very long because they will not bankrupt the country. France will remain a safe investment.
As of course, Jordan Bardella, the National Rally president, and Éric Coquerel, a former MP for France Unbowed, speaking to Bloomberg's Caroline Conan yesterday at the MEDEF event. One of the things we've noticed over the last 5 years, and it's interesting to compare and contrast what's been happening in London and Paris, has been the rise of Paris as a finance hub post-Brexit. This has been a huge feature of President Emmanuel Macron's leadership, but that has now been called into question because of this snap election gamble that he has decided that he is going to deliver. We're joined now by Bloomberg's Alex Rasbandari from the French capital for more on this. Alex, Paris a big beneficiary post-Brexit. Macron's decision to call the snap election putting that at threat. How different could a post-election world be for finance companies in Paris?
Well, as you said it, yeah, most Wall Street lenders have been increasing operations and moving traders here in Paris over the past 5 years. But the thing is, none of this is going to be reverted as of now. When you speak to people familiar with those banks, they believe the uncertainty triggered by the snap election, which blindsided them, is not going to move them to backpedal on those plans for now. They invested with a long-term view, and the uncertainty is not going to change things for now. However, the statehood of Paris was hard fought in Paris, across Europe at the time, And when you speak to lobbyists elsewhere, be it in Germany or in Italy or even in the UK, people are kind of hoping that their own country is going to be a bit more competitive when firms are looking for a place to set foot in Europe.
But is that a short-term prospect or a longer-term one? I mean, so much of the move to Paris was to your point, a function of Brexit years ago. But I'm curious how much of this is just kind of, well, it's going to be rough for a couple of months, but it'll all sort out. Is that the narrative you're hearing, or is it the opposite?
So there are two main views. The decision and the fact that there's a lot of uncertainty about the outcome of this election, right? If one of the two sides, be it the far right or the left-wing alliance, wins, there are worries about taxation. So that could be long-term views, right? And there's also worries about immigration, because the far right stance on immigration has always been quite tough historically. And bankers are worried whether they're going to be able to issue work visas for people that are willing to relocate in Paris. So that could be long-term issues if one of those parties were to form a government in the next month. However, in the short term, the main issue is uncertainty, but it's supposed to be short-lived. And if you listen to your next CEO, Stéphane Boujnah, all those worries are overblown. He believes that the institutional framework in France is strong enough and will ensure that whatever happens next month and whatever majority is formed is not going to be as tough as people fear.
Alex, we heard then from political leaders in France, from both the left, the right, and of course in the centre as well, all punting the blame, kicking the blame around the market reaction. Remind us as to how the markets have been readjusting to the politics on the ground in France.
Yes, well, last week the CAC 40 took quite a hit and raised all gains of the year. It's picked up a bit this week, but it's still pretty much the gains are not really there. Banks have been particularly hit, because they act as a bellwether of the economy, and BNP and Crédit Agricole lost more than 9%. SocGen lost 14%, so that's quite a lot, and they lost more than all their peers. Truth is, the French equities market was ahead of London in terms of capitalization. It no longer is, and it was one of traders' favorite equities markets in Europe, according to Bank of America, and now it's the least favorite. So investors have already voted with their feet, really.
Yeah, from favourite to least favourite in quite quick measure as well. Bloomberg's Alex Rajbandari, thank you very much indeed on the latest out of France and how the politics is tying in to market moves in that country. Coming up, we're going to look at your stocks to watch at the open, including UK home builders, as Labour leader Keir Starmer prepares a blitz of planning reforms if his party wins the election. We bring you the details next. This is Bloomberg.
In London, there is a debate on liquidity.
Yes.
In Europe, there is no debate on liquidity because we have a single liquidity pool by Euronext, a single order book, which is deep and liquid.
But
there are issues on valuation. There are
yes.
issues on multiples, which is totally different from the stock exchange and totally different from the liquidity issue. The issue is valuation and the size of the equity market. And what we need to fix is something which is broader than the exchange, which is how to make European equity great again.
Your next CEO, Stéphane Boujnah, there. Same guy's favorite words, by the way, valuations, multiples. He really talks about the fact, Tom,
they are important.
That not only are they important, but they're going to have this catch-up trade in Europe. He's really talking then about the liquidity and really reassuring the market to some extent. It's kind of his job. He kind of has to. But I thought it was interesting given the context, and he spoke to Francine exclusively about Total as well, and the IPO market, and the fact that there is perhaps a little bit of a scare factor right now that everyone's flocking to the States. It's interesting that he's saying it in the context of so many of these IPOs getting shelved right now. Golden Goose is one example. Tenda Brands, Flix, everyone that was really excited about this capital markets activity maybe opening up. This was the conversation at Super Return as well. Now taking a step back and saying, well, hold on a second. This may not be the best time to do that.
Can we blame the French?
I think they certainly are. They're talking about the geopolitical volatility. What else could they be referring to?
To be fair to the French, it comes before France, doesn't it? As Kriti, to throw France a bone. It comes before this, and you're talking about Shell, and obviously that was muted by the CEO of that company.
Yeah, that story was. Yeah,
and the valuation gap between the energy majors is extreme, isn't it?
But I think there's two different stories there. One of which is everybody wanting to go to the States, and the other one is the IPO story. I think those are two different narratives. The IPO story, I think, is probably more sensitive to the near-term kind of political risk. Yeah. The IPOs, the kind of the transatlantic story is we're going to get a better valuation over there. It's just a structurally better valuation.
Particularly in a nation where you just look through all the green challenges, basically, in the US in terms of ESG and climate change. So you can list in there and you don't get all those additional concerns, right? That's another
If you're an energy company.
Right, if you're an energy company. But you were talking about private capital, private equity. In terms of how they exit, that's a challenge, right? If you don't have that IPO pipeline coming.
Yeah, there's a backlog of it. And this was, again, the conversation in Berlin, that there's so much money looking for those double-digit gains that you may not be getting in the treasury market or potentially rivaling the stock market. Where else do you go? And the answer has been the private markets for someone. But so much of that money is wrapped up. And therefore, you're waiting for capital markets activity to awaken or to really ramp up. And not only is it not ramping up, it's going in the opposite direction. It's actually slowing down.
You want to talk about the Santander Amazon story?
I do. Well, I think it's related, right? I think this concept of weakness in Europe is showing up in the IPO market. Yet you're still seeing specifically Spanish banks, actually, Santander, BBVA as well, talking about consumer banking deals. Santander, the headline this morning, nearing an EU-wide deal with Amazon on consumer finance. A couple of days ago, BBVA, which is in the middle of a potential M&A deal, talking about creating a bigger consumer banking department in Germany, of all places, at a time when we're talking about weakness on the continent.
Yeah, it's interesting. Spain and France feeling like very different places right now. Let's talk about what is happening in the markets elsewhere. Paul Dobson, executive editor for Asia Markets, joins us now. Paul, are the Japanese about to intervene again?
Well, I wouldn't count on it, Guy, but we are close to those levels where the MOF and the authorities in Japan might be starting to get worried again. We're not too far off the levels that we got to, around 160 yen a few weeks ago, that sparked that very first round of intervention for this year that we saw, trying to support the currency, prevent it from weakening further, or at least slow the pace of depreciation. And that's really the key for them. What they say all the time is it's not about the absolute level, but it's about that pace of weakness. And if you look back over where we've been for the last few weeks, we've been pretty steady, just a gradual edging lower. So from that perspective, probably not. But on the other hand, you want to keep an eye out because they do tend to intervene in kind of clumps. And so having done it a couple of times already, the market will be on edge for the likelihood that they'll continue to push back if we do see further pressure. And we are seeing it, across the board from the stronger dollar at the moment in Asian currencies.
We need to keep an eye on the Japanese. We need to keep an eye on the Swiss. Let's talk a little bit about what is happening a little later on today. Expiries in the States, triple witching, volatility to follow.
Well, it could be. We haven't seen very much of that recently, have we? And implied volatility levels are extremely low as well. So that does point to the idea that there could be some pent-up risks out there. It's a particularly large-looking volatility event, but also a very largely skewed one in favour of calls. That's where all the expiries are. Very few puts out there. So if people are looking to cash in rather than roll on, then that could cause more opportunities for sellers to step into the market, to add a little bit of pressure into the US equities. We have seen a little bit of a bump. We got to extremely overbought levels, particularly on the NASDAQ earlier in the week, and that did cause somewhat of a pause, at least for breath, as we get ready for this event that we have to bite off this week. And then again, next week, we have some index changes, people coming in and out. So there will be some scope for extra volatility into the end of the week ahead.
Great timing, Paul. Thank you very much indeed. Paul Dobson, executive editor for Asia Markets. Let's talk about single stocks. Joe's here. He's starting with the drug stocks.
Morning, guys. We're watching shares of obesity drug makers today after a Danish company released some preliminary trial data last night. Now, this is not Novo Nordisk. This is a smaller company also listed in Copenhagen called Zealand Pharma, and their drug called petrelintine, difficult one to pronounce that, showed that users lost 8.6% of their body weight over the trial period versus just 1.7% among the placebo group. Now, this obesity drug is using the hormone amylin, and it is different to the GLP-1s done by Wegovy and Ozempic, the drugs that Novo Nordisk and also AstraZeneca are producing. But those companies also do operate an amylin drug trial as well. So potentially it is a bit of a competition threat for these firms today. We're going to be watching all of those. There's Zealand Pharma on the screen. Novo, Astra, as I say, and even Lilly in the US might get a bit of an impact given their activity in that space as well. All of them doing well over the past year. Meanwhile, I'm also really interested today in Ocado. This stock absolutely slammed yesterday late in trading after they announced that they'd halted the opening of a warehouse that they're building for a company called Sobeys over in Canada. This is one of the retailers that they'd partnered with. The stock fell as much as 18% and recovered to down at 12%. Analysts over at Shore Capital saying this is a blow to their reputation in terms of building robotics warehouses, and questions whether the company may need to raise more funds to continue operating in that sector. Keep an eye to see if we see a rebound in that one today. Also looking at home builders, you mentioned in the build-up there, Keir Starmer looking to potentially push through his housing changes to create another 1.5 million houses in the UK. Now, this is a great chart out of the government team showing the population growth here, the housing growth here, the housing growth not keeping pace with the population growth. Keep an eye on home builders once again today.
Joe Easton, thank you very much indeed. Just very briefly, a redhead crossing the terminal. Britvic, so a company behind brands like Robinson's Juice, also a supplier of drinks like 7-Up, rejecting a Carlsberg proposal of a $1.25 per share for the firm. We could cross that story and see how that one moves, if at all, at the open. Coming up, it is, of course, the market open. We're counting down a little over 5 minutes away. European futures pointing to losses of 0.1%. This is Bloomberg.
Friday the 21st of June. Equity markets yesterday kind of rallied into the close here in Europe, which is a positive sign, obviously, in terms of the kind of direction of travel. This morning, maybe a little bit more cautious. Let me just get the futures up and give you an idea of what the fair value looks like. Maybe a little bit of kind of downside, not by much. Fair value calculation on the Bloomberg kind of points to 0.2% down. So that's maybe what we're expecting this morning. Housing stocks are going to be interesting. Rolls-Royce has got an upgrade this morning. Citi boosting its price target. So that's a stock that we want to watch out for as well. Ryanair has been cut, though. Michael O'Leary, maybe not going to be happy about that one.
Is that a summer story, summer booking story?
I don't know. I need to read more into that. The Barclays. Yeah, he's been more cautious.
The pricing's going to be a little bit softer.
Yeah, pricing's going to be a little bit softer.
Spanish banks in focus for Kriti.
I was just about to say. And also, we talked about England, Denmark, and the ALOC. We didn't talk about Spain, Italy.
To be fair to you, you called the Spain
better game,
and it was a much better game.
I fully
didn't watch
agree.
it, but I heard it was a much better game.
Did you say I was right? Yes. Okay, thank you. Santander, yes, is also going to be potentially moving off this Amazon deal. Remember, I think it's important context that in the States, Amazon has tried to already create kind of a consumer banking wealth unit and was actually got a little bit of pushback. It was in line with JP Morgan, with Berkshire Hathaway, et cetera. They did it with a healthcare unit as well, and it wasn't as successful. So it's interesting that they may be potentially partnering with Santander on it.
We're watching the home builders as well.
Yep.
There's a bit more detail in terms of Labour's potential plans if they get into office. And, of course, the expectations that maybe the BOE goes with a cut, which would be helpful, of course, for that sector.
Tech was strong yesterday, bouncing back from the previous day. The other thing I'd mention as well is oil's on a bit of a tear right now. So just keep an oil story kind of front and centre in your mind. ASML was the biggest points gainer yesterday. It was up by 2.32%. So tech was strong yesterday. But let's see what happens this morning. It is Friday. We're waiting for triple witching a little bit later on. In terms of the early losses, you've got L'Oreal down a little bit this morning. United Utilities, British American Tobacco, Unilever, a more defensive bias, I would say, at the top end. Utilities also having a fairly good morning and start to the day here in Europe. But it's early doors in terms of where the points gains are coming through. Flutter also having a good day as well. I wonder if that's because of the 1-1 draw last night.
OK, the leisure and entertainment. Nothing to do with, of course, members of the Conservative Party putting bets.
You want to go down that road? I'm going to stay well away from
just
that
another
road.
mess in terms of the election campaign. Right, in terms of how things are playing out across individual names, we're looking at the Spanish banks, we're looking at UK banks as well on the back of what's happening there. On an individual basis, you've got a little bit of pressure coming through on the tech space then. You were talking about the fact there were some modest gains coming through yesterday. ASM is currently down 1.6%, so giving up some of the gains that came through. On the upside, as you say, Flutter Entertainment gaining 1.5%. Ocado Of course, in terms of the robotics and the supply around the grocery space, up 1.6%. ITV also one of the key gainers as well, at least so far. There's Travis Perkins and Smith's Group as well, coming through the gains on the real estate sector.
So utilities are up, travel and leisure is up. That's more of the leisure than the travel, I suspect, on the Flutter story. But as you say, technology is where the weakness is. I find it interesting that retail is softer today, despite that better UK data.
Carlsberg as well, down close to 3%, down 2.7% in Copenhagen. Britvic rejecting that deal, that company, that supplier of soft drinks in the UK, rejecting the offer from Carlsberg.
I think Sweden and Norway, talking of the Scandinavian markets, Sweden and, or going a bit further north, Sweden and Denmark, Sweden and Norway are closed today, I think.
Finland and Sweden.
Finland and Sweden.
Good effort.
I nearly got there. We're going to park Norway to one side.
Yeah.
They're outside. They're soaking up the longest day. I hope the weather is good for them.
Is that the actual reason?
I think so, yeah. Genuinely. I'm not kidding.
We don't know that for sure. Anyways, you mentioned the commodity names as well that are actually weighing down the index today. You've got your Rio Tinto, you've got Shell as well, Glencore as even BP is lower on the day. I thought that was interesting. Some of the healthcare names as well. GSK, Sanofi also underperforming. So that I thought was a fascinating one. Schneider Electric, your favorite guy, also one of your biggest downside movers on the Euro Stoxx 50.
That's interesting. I want to check that one out. Clearly, that has been one of the biggest beneficiaries recently in terms of the AI story. Is that something?
Is that part of the tech underperforming trade?
Yeah, possibly some kind of element to that, I think. Looking ahead, though, we're waiting for the PMI data. Let's just kind of keep that on our radar as well. That is going to be something that the market is going to pay a great deal of attention to a little bit later on.
Yeah.
We've already had strong data out of the UK. What is the PMI data going to tell us, both out of Europe and out of the United States? So that's going to be something we're going to factor in the next hour.
Max Kettner of HSBC telling me earlier in the week that because of the improvements in the Eurozone economy, he actually favours small cap stocks in Europe and the banking space as well. So as that data comes through, expecting to come through relatively strong for services and a little bit of an uptick in terms of manufacturing, does that build a case for Europe as we look maybe look past those political risks and focus on the economic data in Europe?
Yeah, speaking of the banking space as well, quick update on Santander. It is actually your biggest weight on the IBEX as well, down only 0.3%, but still perhaps some skepticism around that deal. One of your biggest upside movers, though, on the IBEX is BBVA, and I bring that up specifically because of the consumer banking stories that both have talked about or been reported to have been talking about during this week. So that's going to be one question in the banking space more broadly, is that just given the geopolitical turmoil, from a valuation standpoint, look fairly cheap. That's the banking space, at least in Europe, similar to perhaps the conversation they're having around tech in the States. This is one take from iCapital's Anastasia Amoroso on those valuations. Take a listen.
You have to trade this market. You have to take a week to week. And, if I look at NVIDIA right now, if I look at the NASDAQ, if I look at, for example, the relative strength indicator, it has been screaming overbought for probably the last week or maybe a little bit longer. And when you have this condition, something is inevitably going to happen and you're going to have some consolidation. You're going to have some pullback. So, yes, I do think the trades like NVIDIA and the NASDAQ near term are overstretched.
Shanio Ramji, co-head of multi-asset Pictet Asset Management, joins us this morning. Thank you. Pleasure to have you on the program on a Friday morning, nonetheless. Your take on valuations, do they matter right now on either side of the Atlantic, given the momentum in the tech space?
I think valuations do matter when we're in extremes, and especially if earnings aren't keeping up with those valuations. And what we see today is that, especially in the tech space, we are seeing earnings really out-earn the rest of the market. So for us, we still see momentum continuing. Now, we'll see some bumps along the road. As we heard there, it is quite overbought at the moment. Of course, we have some options expiry today that could end up being a little bit of breather for the market. But we don't think this is anything material to worry about because the long-term story remains intact.
Remains intact, but the earnings momentum can only go for so long. Do you have visibility on when that might snap, or when at least might even slow down just a touch?
I think the expectations need to moderate somewhat. What we are looking for is the big capex expenditure that's coming through on the mega caps are really going to filter through to a lot more of the supply chain. So the next move, what we're looking for in the tech space, is how that AI supply chain really starts to join those mega caps rather than the mega caps falling towards the rest of the market.
What do I do right now? I've got lots of political risk. I'm trying to figure out what the uncertainty is going to do to my portfolio over the next few months. Do I forsake the high-performing tech sector and build a diversified portfolio and accept the underperformance? I'm trying to ask everybody this question right now, trying to understand how people are thinking about their portfolio construction.
I think it's an interesting time to start looking at broader parts of the market. What we are seeing is earnings revisions across the market away from those mega cap stocks start to improve. Now, the multiple needs to be raised in those stocks. And what is required for the multiple to be raised is, I think, a little bit more clarity on what we're going to get on the rate side. So whether it's in Europe, whether it's in the US, a little bit more clarity on when and how much the Fed is going to drop rates. And that's going to, I think, give the market much more confidence in re-rating the rest of the market. Because earnings are improving, and that's a good sign.
How do you factor political risk in?
We have to think about it from the point of view of cost of capital. Now, what we're seeing in France is the cost of capital is really moving quite fast. So how does that impact French companies, or indeed European companies as a whole? Are companies able to refinance their debt? Are companies coming to the IPO market? Are investors staying away from the European market just to wait and see? We think that this could present an opportunity in European stocks, especially if we get that risk premium built in, and in fact we get let's say a benign outcome, a hung parliament where you don't get any spending in meaningful way, but they still have to have some debt consolidation in France.
Would you be buying now on that, or do you need to wait for the hung parliament to be confirmed and then you buy? And if so, where do you buy? What do you buy?
I think it's difficult right now with the Marine Le Pen's party going out in front. I think all parties, whoever wins, if there is a clear winner, will have to do some hard thinking about their spending plans, because the deficit in France is already 5.5%. They can't use the TPI, which is the anti-fragmentation tool of the ECB, if they don't do any debt restraints or fiscal restraint. So I think one of the gambles that Macron might have made is that if you're going to be in power, you're going to face these hard choices. So I think for us, we'd need to wait to see what that result is and then act accordingly.
We've been talking about the flow story into UK equities. Do you follow that? Do you chase that? Is there further upside for UK stocks? It's been modest year to date. We've got the cyclical story. We've got the commodity story. Guy was flagging the fact that oil has seen some strength in recent days, about $85 a barrel. What are you thinking about the UK?
It's had a good run so far. And what we are thinking about is, look, to what extent do we have to concern ourselves with some political risk over the next few weeks? When it comes to the mega cap stocks, oil and gas, banks, are we going to see any more levies on those companies? But what's interesting is the mid-cap space, because if we get, for example, a better relationship with Europe, does that mean that mid-cap stocks have a little bit more room to go in terms of that multiple, in terms of their trade with the European Union?
There's been a narrative in this market, I'm going to go from equities to bonds, but there's been a narrative in this market that there's still so much cash on the sidelines because you can basically take 5% in the front end of the U.S. Treasury market and enjoy that. I also read a fun fact that over the last 10 years, the S&P 500's averaged something like 12% annual gains. Is 5% enough? Is 5% enough yield in this environment?
Unfortunately, I don't think it is. I think if we think about wealth, retirement over the long run, 5% in real terms, that's going to be 1 or 2% maybe, if you're lucky. That's not enough. Investors need to go out across that risk curve, and we think credit is interesting. We think equities are still interesting. And over the long time, that compounding is going to be a better investment, we believe, than cash. The capex that I talked about still shows that companies believe that they can out-earn or they can receive a better return on their cash by investing. So should we.
Is that perhaps a reason that the bond market isn't catching a bid? Outside of the monetary policy, the fact that 5% isn't enough, to your point, and they are looking for other places, is that accelerating or creating some sort of floor in yields?
I think to some degree it is. I think the other is the fiscal question. Who are you lending to, and is there more bonds coming down the pipe every single month? And that's what I think investors are worried about. And of course, we have the issues in France and Europe, but of course in the United States coming in November with fiscal spending very high on the agenda of both candidates.
It's probably worth pointing out that French PMI data is about to drop. We'll get a pretty good taste of what is happening with the French economy right now. We'll come back to that in just a minute. Shanil, great stuff. Thank you very much indeed. Shanil Ramji, co-head of multi-assets at Pictet Asset Management. Let's take a look at what's happening with the Core 6 this morning. A couple of stocks you really want to focus on. ASML has had a choppy ride over the last couple of days. down, then up strongly yesterday. Today we see a little bit of softening, but broadly actually quite a lot of negativity around this market. LVMH is flat. Keep an eye on Ferrari. We're going to bring you the new Bugatti a little bit later on in this programme. A fantastic interview that Ollie Crook's done. We'll be talking about Rimac Bugatti and getting a flavour of just how fast that one's going to go. Ferrari, hot on its heels, of course, in terms of performance. Let's figure out what other stocks we want to be watching out for. Joe Easton has all the details.
It's Friday, guys, so we need to talk about booze. We have got a surprise breaking news in the deal space in terms of drinks. Now, Carlsberg coming in for Britvic, the UK company, the latest UK company to get a takeover bid. Now, we did not expect this one. It is at $12.50 a share in terms of the price. We're coming up around 15% at the moment for Britvic, and Carlsberg actually dropping 5%. Investors not liking this news. Carlsberg says it will go away and reevaluate its position on this and see if it comes back with a later bid. As I say, it's not quite coming back to the bid price at the moment, but Britvic, the best performer, the biggest gain for that stock in 12 years this morning. The ones down here, these are share sales. Intercos and Fincanrini over in Italy. Investors offloading some stakes in those this morning in the Italian industrial space. I want to look at chip makers as well, because that sector is the weakest in Europe today. All of them hit. Now, the US tech sector did decline last night, and there was also, interestingly, a profit warning out of a US company called Jabil that sells into the EV space. Analysts at Bloomberg Intelligence today in a note pointing to that as weakness for potentially Infineon and ST Micro in terms of their outlooks there. As I say, red across the screen in terms of chips today in Europe. Then in those obesity stocks that we were looking at earlier, there's Zealand Pharma. Wow, I didn't expect that actually. Up 26% today. As we said earlier, their drug showed significant weight loss versus the placebo in an early stage trial, but a massive jump for that over in Copenhagen, up 25%. Investors will be loving that one today. Novo Nordisk coming down slightly, a bit of a which makes a similar drug to Zealand Pharma, so those are in focus at the moment. Then we're going to flip over and have a look at some other movers on the board here. It's the UK home builders and retailers. We did get news. Keir Starmer wants to push through his home building plans as quickly as possible. Will tell ministers to get on the case in terms of telling councils to build more homes. So we're seeing a bit of a gain there. And the UK retail sales numbers were much better than expected, but not too much of a movement in Next. That one pretty much unchanged at the moment. Ocado bouncing back following a 12% drop yesterday on news of a collapse of one of their deals over in Canada, as we discussed earlier. We're going to flip over and look at a German stock called Varta. Now, this one, it's also kind of in the chip space, but it actually does the batteries that go in your AirPods that I'm sure, like me, you've all lost about 5 times and had to replace. So that is a pretty strong business. But they've got a profit warning out today, and the stock down 8% at the moment. Finally, one more airline. You did mention that broker move over at Barclays, but Barclays is also downgrading Wizz Air alongside Ryanair. They say Wizz Air is suffering from the weaker pricing. That one's dropping 2.7%. Ryanair also lower. Keep an eye on the airlines today.
Joe Easton from our equities team. Thank you very much indeed. We are counting down to the data out of Europe, particularly with France. That is coming in the next 30 seconds or so. Manufacturing and services PMI, and how that could tie into our picture around the strength that's coming through for the Eurozone economy. The modest strength, of course. Manufacturing PMI expected to come in at around 46.8. So a modest tick up in both of these indexes is what expected. And again, we'll see. Pricing in terms of the ECB, September, October, markets are basically split after that cut as to where the ECB goes. Does the strong, if you get strong data, what does that do to that forecast? Manufacturing PMI then falling. Well, there we go, 45.3. The estimates had been for 46.8. So it's weak in terms of manufacturing PMI for the month of June out of France. 45.3, well below the survey of 46.8, firmly in contractionary territory. And services also slipping as well. 48.8. The estimates had been, the survey had been for just shy of 50. You are still in contractionary territory for services as well. 48.8. These are pretty soft numbers out of France.
I think it captures the survey period, some of the election jitters that we've got. So I wonder whether that is being, to what extent that is being factored into the numbers that we're seeing on the screen in front of us, and how much of that is still to come, I think will be an interesting question. But yeah, these are weak data. This is not the picture that we were hoping for out of France. An economy that we were hoping was recovering feels like it's stalling again.
weakness in the euro off the back of it, 106.96, so breaking into 107. This is a consistent theme that we talked about with even our FX guests earlier in the program, talking about this persistent weakness in the European, or in the euro, I should say, that perhaps could be creating some strength into the pound as I want to use this term very carefully, but as a temporary safe haven in terms of the currency picture. I think it's interesting that the euro has seen so much weakness off of the geopolitical story, but this data certainly does not help.
Just trying to read in to the PMI, the S&P narrative. France's private sector economy endured a challenging month, they say. The data revealed a solid and renewed decrease in total new orders, pulled output further into contraction. This marks yet another setback for the euro's second largest economy at the end of the first half of 2024. So they're painting a pretty negative picture in terms of what they're seeing here. Sharper rates of decline were witnessed in both manufacturing and services during June, although the contraction was more pronounced in goods producers. So it feels like this is less services and maybe more to do with what we're seeing out of the manufacturing sector, which is something that we've seen fairly consistently. I'm just trying to see when the survey date period was, just to give an idea of what is happening here.
As you look into that, Guy, so it was interesting reflecting what Themis had to say, Fiatakis at Barclays, saying that he is cautious as well about the story in China and how that plays into Europe, particularly in the second half. And, of course, France's manufacturers have exposure to that market. And if you see further softness in the Chinese market, particularly in terms of demand, then that could also prove challenging for the Eurozone economy. But in terms of the overall number that drops at 9 a.m. UK time, I'm going to adjust this, but the expectation had been that you would see a tick up in both services and manufacturing. The French number may adjust that. That drops at 9 o'clock for the whole Eurozone.
And we should mention that as we're speaking, we're seeing a widening of the spread between the French and German bonds, a bit into the Bund market as well. 238, 239 almost, we'll call it, on the 10-year.
This is, again, a comment from S&P in terms of what they're saying, and this is obviously in alliance with the Hamburg Commercial Bank. The French economy seems to have weakened again in June, with new orders coming in lower, especially from the services sector, which is maybe stands in stark contrast to what I said just a moment ago. For the third and fourth quarter, we expect a GDP boost, though, from the Olympics taking place in July and August in France. I wonder now whether that is countered by the politics. The fact that you've got the Olympics coming up, whether actually the French political turmoil will kind of eclipse that completely.
We haven't often talked. We haven't talked about the Olympics at all in terms of feeding into the economic story. Historically, when you look at the Olympics, or at least the economics around Olympics, it tends to be a drain on countries' finances as opposed to in terms of investment versus tourism revenue.
Well, I think initially you get a boost.
There's the short and long term, isn't there?
Yeah.
But what I'm hearing, though, is that actually a lot of people aren't going to France. People are going for the Olympics. But the kind of traditional tourists that would go to France from America, etc., will not be travelling during that period. So again, I wonder how the effect will kind of set off one against the other. Anyway, we need to talk more about that. We'll certainly bring you the German data, which is going to be dropping fairly soon as well. I want to talk about French cars, though. Bugatti unveiling a $4 million 1,800 horsepower hybrid hypercar, the Tourbillon. We are going to hear from the company's CEO, mate Rimac, is going to be on the show very shortly. Ollie Crook's been doing done a fantastic job with an interview with him. That's coming up. This is Bloomberg.
In the vast range of really, really expensive supercars, very few come as close in price to a Bugatti. They've lived up to their reputation with their newest model, the Tourbillon. Replacing the Chiron, it was redesigned from the ground up, and it had to be. It's their first ever hybrid model. With an 8.3-liter naturally aspirated V16 engine, plus 3 electric motors, it packs a whopping 1,800 horsepower, propelling it more than 400 kilometers or 250 miles per hour. And it can be yours for a starting price of 3.8 million euros.
I'm very pleased to be joined by Mate Rimac, who is the CEO of Bugatti Rimac and joins us now from Zagreb. Thanks so much. Really great to speak to you. Very exciting car that we now have off. I think it's really interesting for Bugatti because every time you guys release a car, it's not a car for a couple of years. It's a car for something closer to a decade. You have now decided to release your first ever hybrid. You have an electric car background. Why did you stick to the ICE?
Well, actually, as you say, each new Bugatti is a big occasion. But a completely new one, developed completely from scratch, which the Tourbillon is something that comes around only every few decades. Let's say shareholders were pushing that the next Bugatti should be electric. And at that time, that might have been sounded like the right decision.
And you mentioned your your customer, who is obviously a very unique customer, a very rich customer, but a very sort of savvy customer. So why for them is the starting price 3.8 million euros? Why is this car worth that?
Well, it's Bugatti, first of all. That's something very special. But you can see by looking at the car and by feeling the car, it's very unique at every detail. For example, one of the things we wanted to achieve that every piece of the car is actually a piece of art for itself. So you can pick any piece up, put it on in a gallery, and it would be an exhibition piece, even without the rest of the car. If comparable, it's no longer Bugatti. So it's something completely unique and something completely different than anyone else. And also what I said, nothing is too beautiful, nothing is too expensive.
I want to understand where you're selling most of your Bugattis right now, and where do you see geographically the most promise?
1/3 of the market is US, 1/3 is Europe, and 1/3 is the rest of the world, mostly Middle East and a little bit Japan and some other markets. We currently do not sell at all in China. But the market of ultra high net worth individuals is growing constantly, and I think it's predicted, or it's pretty clear that the market will continue to grow.
How is the Bugatti customer, the kinds of people buying the car, changing? Is there a sort of a shift in the age? Are they becoming younger? Are more women buying? What are you seeing there?
Yeah, we definitely see a shift, especially, let's say, young tech entrepreneurs, be it through from the finance space or online gaming or some kind of, let's say, new businesses that are more in the energy sector or tech in general or real estate. We see that changing a lot now. So a younger audience being interested in the brand. And I mean, Bugatti stands for you made it. It's the ultimate you made it symbol.
You must crash test these cars. How painful a process is that?
Yeah, well, there is no shortcuts in producing very expensive or very low volume cars. Actually, we, even from our perspective, regardless of the regulation, we want to make sure that these valued customers are very safe. So we do thousands of tests and hundreds of homologation tests and crash tests. So we have to build something around 30 prototypes in the development process. And around 15 of them will be crashed multiple times over and over again until we pass all the crash testing.
This is Marks Today. We're at 30 minutes into the European trading day. And right off the bat, we are seeing the German PMI numbers coming in significantly softer than expected. June manufacturing PMI falling to 43.4, estimated at about 46.4. So a softer print than we were expecting. Similar story in services as well, 53.5. Forecast there was 54.4. Continued weakness in the euro off the back of that 106.78. And that's just coming off the back of the weakness we saw in the French numbers as well.
Manufacturing. Wow, 43.4.
That's brutal.
The estimates are 46.4. A big drop in terms of what's coming through for manufacturing out of Germany. It's always supposed to be consensus amongst our guests that we've been speaking to, that the story around the economy of the Eurozone is turning around. Is it?
I don't know. I come back to the website and look at what they're saying about the data having this dropped. After showing some promising signs of bouncing back, the manufacturing sector hit a wall and started moving in the opposite direction in June. That is not a positive comment. regarding the German manufacturing sector. It was really interesting talking to Temos earlier on, talking about the fact that he thinks there's some China weakness beginning to show up in some of this European data.
In terms of the market reaction, a continued bid for the Bund market as well. No surprise there. But this is a conversation we've heard in terms of the spread between the French and German bond market. Yes, there is that kind of sell-off in the French market from the geopolitical risk, but there's also a giant bid into the German Bund market as well, especially as you start to see cuts priced out for the Federal Reserve. There is a fund flow story there as well.
6 basis point move on the 10-year, the German benchmark. And as you said, there's money flowing into German debt as well, but less pronounced. 6 basis point move on the 10-year. And in terms of the WIRP function, in terms of the ECB then, and expectations there, fully priced now for October with the next cut.
More comments. Fortunately, Germany's economic performance is not only based on the manufacturing industry, but also on the service sector. The latter continues to be in good shape. So a kind of two-speed economy. Very much still evident in Germany. The service sector continuing to perform relatively strongly. That's obviously producing some of the sticky inflation that we're seeing right now. Manufacturing, they're describing it, S&P Global talking about it hitting a wall. That is not the kind of language you want to hear.
I'm having a little bit of deja vu because this is the exact story in the States as well. Manufacturing is weaker, services is stronger, but the difference is Germany is a manufacturing-driven economy, whereas the US is, of course, a services economy. So that, of course, working against it.
The ECB's persistent headache these days is inflation in the service sector, just reinforcing that point.
Yeah, and a similar issue, of course, for the BOE as well. The European stock 600 currently down 0.2%. Over in Germany, the DAX off by 0.3%, dropping 52 points. How does all of this, in terms of the macro data, talk and feed in to the public markets and appetite for activities and deal-making? Lazard's CEO, Peter Orszag, has told Bloomberg that the company is weighing several opportunities to acquire a private credit firm that would help expand its $250 billion asset management arm. He spoke exclusively to Bloomberg's Francine Lacroix about the company's ambitious expansion plans.
In the asset management space, we need to protect where we are. We need to expand by doing some additional hiring where it makes sense in public markets. And then we need to acquire. And the acquisitions will be disproportionately in private markets, so in private credit, infrastructure, real estate, places where we are not very present yet.
That was Peter Orszag, the CEO of Lazard, speaking to Bloomberg exclusively. Now, very pleased to say we are joined by Charles Hayes, a global co-head of private capital at Freshfields. Charles, thanks for joining us in the studio. We're just talking about the macro data, the Eurozone. We're talking about deal-making as well. Then we've got the political risk. You have seen a pickup in M&A activity. Does the momentum continue? Can deal-making continue to push through some of these risks?
Good morning. Thank you. Well, absolutely. So H1 global M&A volumes up 23%, in Europe 37%. I think what we're seeing and what clients are telling us at Freshfields is that they're reconciled now to a relatively higher interest rate environment for a bit longer, notwithstanding some of those inflationary pressures easing off. You mentioned the services sector earlier. But we're seeing a lot of assets that have traded. We've seen some IPO exits, Puig, Galderma, CVC, of course. And so the outlook, I think, and hearing from our clients, is looking pretty strong for the rest of the year. But what is clear and what we would say is that will be a non-linear recovery, that is for sure. OK, so it's a non-linear recovery, and some of these companies are adjusting to that higher rate environment. What does that mean for the kind of deal size that's coming through? Absolutely, absolutely. So what the data shows is that some of those deal sizes are a bit smaller. It also shows that some of those deals are in some downside protected sectors. But the playbook, the PE playbook, is evolving, and it's going back to some of those pre-lower interest rate environment playbooks. So we're seeing a real focus on value creation. We're seeing a real focus on portfolio company buy and builds. But having said that, if you think about some of the sectors that our clients are investing in, whether that be healthcare, life sciences or tech, they are evolving, and where previously it might have been a patents book of business that they were looking to buy, they're now buying assets in blood plasma technologies or intraocular lenses, or in the tech space in data centers. So this is becoming a fascinating area that's evolving very quickly. What does deal flow in the UK look like post-election? What clients are telling us at Freshfields is that they really value certainty and stability. So what we would say there is that some of that, to agree, is now priced in as the likelihood of a Labour government looks more and more predictable. We've seen in the last few weeks some of that deal volume has started to pick up almost on the back of that already. So what will be interesting there, I think, is to see what trades before the summer. Right, so that's what we're seeing in terms of the acquisition strategy. Let's just go back to the IPO story as well.
private equity needs to unload assets. There is a clear need to return money to shareholders. How much of this is forced is the wrong word, but how much of this is a need to get businesses out of the door fairly quickly? I'm assuming they start with the most easily sellable businesses and then work down from there. How far through that process are we, and how difficult is it even to unload some of the more sort of the higher end, easy to offload companies right now?
So timing is everything. And I think what we've seen is that some assets that are incredibly good assets have not traded in circumstances where you otherwise might have expected them to. Yep. And that's driven by two things. Firstly, because there's a valuation expectation, and secondly, because there's a premium desire on the behalf of the GP that's exiting. On the valuation side of things, we're seeing some of that valuation asymmetry start to close. Earlier in the year, it was sort of 20 to 30%. It's coming down to 10 to 15%. But remember, the IPO exit is not the only exit available. So we're seeing a massive uptick in the secondaries market, 37% up this year alone. And then you've got sales to strategics and sales to other sponsors. So the IPO story is only part of the picture.
There's also a concern about how nuanced some of these deals are getting. There are Jamie Dimon, for example, I love to go right back to this, really issued a warning on some of these private capital deals, saying that the deals not all of them are worth their salt in terms of the credit ratings that they're getting. I won't ask you about the credit ratings themselves, but I am curious about some of those deal structures, because you're hearing some of this pressure for mega deals, first of all, in terms of this big influx. On top of that, you're hearing some of these like covenants and financing options get more and more in the weeds. Critics of that would compare it to the housing crisis or the way the mortgages were written back in the GFC. Where do you stand on that?
Clearly, as this sector becomes more involved in aspects of the economy that hit consumers, that are exposed to more regulation and exposed to other parts of the economy which are necessarily part of the effective function of these markets, they're going to come under increased scrutiny. We've not seen those kind of pressures yet with our clients. That might be a function of the kinds of assets that they've invested in. It might be a function of the sources of financing that are available to them, whether that be private credit, leveraged finance markets, syndicated loans, whatever that might be. But right now, we're not seeing those pressures with our clients.
The partnership between the banks and the traditional PE firms has been really interesting as well post-GFC in terms of building this kind of gap in liquidity where I think a lot of the traditional financing kind of disappeared. What does that relationship look like going forward? Is that the new normal?
I would say that's the new normal. What clients are telling us is that we can expect to see a slight rebalancing over time, but a lot of those pressures, as I mentioned, have not come through in the way that's been anticipated, and market commentators have, I think, been surprised with the lack of stress almost that we've seen in the system.
A lot of it follows, however, what we're seeing in the public markets, especially when you look at some of these software enterprise deals that are happening out of Silicon Valley, even in the private markets as well. The valuations look almost as stretched as what you're seeing in the public markets. What does that delay look like? What does that read-through look like? If you see some sort of crack in this momentum-driven rally in the public markets, how long for it to show up in the private ones?
The private markets are clearly not immune to the public markets. However, there is a degree of pricing asymmetry, and we see that, for example, in the way a lot of our sponsor clients are deploying capital into the public markets, playing to that arbitrage effect between that pricing asymmetry. We've seen a number of recommended bids in the UK alone in the last few weeks. So none of that surprises me, and we'll just have to see how that plays out.
We'll have to bring you back to give us those updates. Charles Hayes, Global Co-Head of Private Credit at Freshfields Bruckhaus Deringer. We thank you so much for joining the program. In the meantime, I read a headline crossing the terminal from Bruno Le Maire, the finance minister over in France, saying, do not underestimate the promise to reduce public spending. Remember, he has made that promise that by 2027, he'll get the deficit below 3%. The S&P saying, we don't believe you. Coming up on the program, we're going to dive a little bit more into that. French President Emmanuel Macron's opponents face hostility from business chiefs as they lay out competing visions on how to fix their public finances. We'll get the latest with Marta Lorimer, lecturer in politics at Cardiff University. That conversation next. This is Bloomberg.
I think you're the one causing the concerns on the markets in a pointless manner. We have decided to widen our majority because I think there is a real danger today to see Jean-Luc Mélenchon and the far left coming to power, which would make France like Venezuela without the oil.
The first panic on the markets was linked to the snap elections call, so go and ask Mr. Macron why he thought it was a good idea to worry the markets. I don't think our policies will worry them for very long because they will not bankrupt the country. France will remain a safe investment.
The right and the left, Jordan Bardella, the National Rally president, and Eric Coquerel, a former MP for France Unbowed, speaking to Bloomberg's Caroline Conan yesterday outside the MEDEF event. The French business group grilling some of these politicians, trying to get to the centre, the heart of what their economic programmes would likely look like. What do we think the likely outcome of this vote is? We saw some Harris polling yesterday suggesting that Marine Le Pen's party is still out in front. Martha Lorimer, lecturer in politics at Cardiff University, joining us now to give us an assessment of what this looks like. Martha, good morning.
Good morning.
What's your central case? What do you think is going to happen here in these parliamentary elections?
I think my central case is really that we are going to end up with a hung parliament. So we're going to have 3 blocks within it, and none of them really wants to work with each other. The problem is that they're going to have to find some kind of way out of this, because once an election has been called, you cannot call another election for a full year.
Okay.
So this is unprecedented territory in French politics, so we really don't know what is going to happen.
Should the markets, should French business be worried, terrified of that outcome? What does it look like from an economic point of view, from a business point of view?
I mean, from a business point of view, there's something to be said for stasis, for absolutely nothing happening. So no government also means no measures, and things keep going. So there is perhaps some cause for calm. But at the same time, it is also going to be challenging, because if you have a divided parliament, there's also no political intervention that is really possible.
Is the National Rally going to put up with stasis, though? We've heard from Bardella saying he wants to see that majority, presumably so if they can push through their agenda. What is the most likely policy outcome in a hung parliament scenario, or indeed if they get the majority that the National Rally are pushing for?
Well, if the National Rally gets a majority, then they don't really have a problem in terms of getting their own measures through. The problem is what their measures are and whether those are going to fly particularly with the European Union. So Jordan Bardella has already said that as far as he is concerned, their economic priorities are lowering the VAT on things like fuel. And that is going to get him in trouble with the European Union because, of course, that is not something that he has control over. And he's already said that he wants to renegotiate the French contribution to the EU budget, which, as we all know, is not the kind of thing that you can get away with doing in 2 months or even a year. So he is going to run into trouble. If they don't get a majority, Marine Le Pen has already stated that Bardella will not accept the position of Prime Minister, and that might actually suit them much better, because it does mean that they don't have to take any form of responsibility, and that the next time there is an election, they can basically blame any issues on everyone else who either didn't want to work with them or who tried to pass any kind of measure in a divided parliament.
Because the view from some looking at this has been, yes, it was a surprise from Macron, but maybe it's smart because then you test them in terms of governance if they do win, and when they get tested, they fail. But you say that that's questionable.
That is very questionable. So that kind of reasoning might have worked in 2000 when the Freedom Party of Austria, for example, came into government. We, at this point, have a lot of experience with far-right parties in government. I mean, Italy is the best case that we can think of right now. And what we see is that far-right parties in government don't always necessarily spell disaster. Sometimes they can actually govern with some form of confidence and competence. The problem, of course, for the National Rally, and which is what makes it very, very different from a party like Giorgia Meloni's Brothers of Italy, is that they genuinely have no experience of power. Giorgia Meloni had her party's predecessor was in government in the early 90s, has been in government in the past. She was governing with the League and with Fratelli d'Italia. So she had a coalition government of people with some experience of power. This will not be the case for Marine Le Pen. And this is why she's already hinted to the fact that she might want to work with technocrats or with experts of some kind. So she would be something a lot more similar, again, to, for example, the five-star movement in Italy.
So at the end of the day, I love the comparisons you made to the other parts of Europe. At the end of the day, is gridlock kind of the best-case scenario, especially in the context of tackling the public finances? We just got headlines from Bruno Le Maire saying to not underestimate France's ability to tackle them. If the deficit is in question, is gridlock the best-case scenario?
Gridlock is potentially it's potentially a workable scenario. It's better than, say, a national rally-in government that starts picking fights with the European Union, or a national rally-in government that you don't really know what it is going to do. If there is instead some kind of sensible centrist alliance that forms, so, for example, something bringing together Macron's party with parts of the left and the centre-right, Les Républicains, that would also be a potentially workable majority. But it is very hard to see how political parties that have been so adversarial with one another over the last basically 2 months could actually work together.
I'm going to continue on the deficit story as well, because you mentioned Marine Le Pen and the thought that if she is brought to power, there would be a kind of uncap on spending and therefore perhaps an irresponsibility with finances. At least that's one narrative out there right now. What brings it down? What brings the deficit into control for those who are saying, Bruno Le Maire, we don't believe you?
Well, according to the National Rally, what brings the deficit into control is, again, reducing contributions to the European Union, tackling spending on migration. So one of the things that they have said is that they want to cut the medical aid to undocumented migrants, for example. So some taxation, possibly for some of the richest companies, is something they've also discussed. But the real issue is that we absolutely have no idea what the National Rally does in government, because they've never been in government. And one might want to ask if it's really the time to try it.
Who could be the finance minister? Are there any names floating? Have you heard any names? I'm really struggling to find out who could be the finance minister of France after Bruno Le Maire, say the National Rally won a majority.
I don't think they've discussed names. I think if they have learned something, again, from previous experiences of populist governments, is that they would be looking to, again, some kind of technocratic figure. So someone who is not seen as a deeply political person, so that they can at least draw on some credibility from an outsider from the party.
Marta, thank you very much indeed. Really nice to see you. Thanks for stopping by to see us. Marta Lorimer, lecturer in politics at Cardiff University. Thank you very much. Kriti.
Well, in the face of all that geopolitics and in the face of what you're already seeing in terms of the weakness in the data that we've covered, there are still a few folks who are saying this is a buying opportunity. We'll go right through it. Take a listen to what some of the guests this week had to say.
There are some very good global players in Europe, strong secular growth players, and we would want to take advantage of that. Some of the corrections are overdone in our view.
It's a great day to invest in Europe.
When it comes to the government bond market, we have a preference for European government bonds and UK government bonds over US treasuries.
Positioning is very light. Nobody wants to be invested in Europe. Everybody's underweight Europe.
Can't help myself but be optimistic, because against all that, you got a valuation 10 points below the S&P.
Sentiment is awful. Look at the elections, the growth prospect.
What I would look for, actually, is for the euro to stabilise first, and then maybe the equity market will follow.
When you look at projections for economic growth, the consensus is expecting Europe to rebound and start growing again in 2025, 2026, as opposed to what you're seeing in the US, where we have a slowdown.
So some of the guests there on Bloomberg Television, on the show actually, who've been actually very optimistic about Europe. That last voice coming out of TKO saying a rebound in Europe is likely to come, if not in the back half of this year, in 2025, in 2026 as well. That's really interesting given the context that we just saw earlier in this hour from France, from Germany. Not just weakness, but more weakness than even estimated.
The French manufacturing sector is hitting a wall. According to the data that we've seen, according to the commentary, the French data is weak. The service sector in Germany looks okay and is remaining relatively strong, and that's a problem for the ECB as well. But this doesn't feel like an economy that's reaccelerating. It feels like, according to the commentary we're getting from S&P, this is an economy that feels like it's slowing down rather than speeding up right now.
48.8 on services. To your point, there's a divergence between manufacturing and services. That's not new, but it's become more pronounced in Germany. And is this a one-off set of data that challenges the narrative, or is it a set of data that's going to be followed by further weak data out of the Eurozone that suggests that actually it was always built on pretty fragile foundations?
Okay, you tell what's happening in China. You tell me. Because that's going to have an impact here.
Yeah, Tom.
China has...
Tom's our expert on China.
No,
so
100%.
Tell me what's going on in China.
China has not come through with the measures that are needed to turn around the... Until you get the property sector sorted out in China, which accounts for 20% of GDP, then you're not going to get the consumer back. The consumer is so heavily invested in real estate because they have so few other options to put their savings to play. It's invested in real estate. Prices continue to drop. Until that changes, the consumer in China will remain challenged and depressed, and therefore will not be buying as many LVMH bags, luxury goods, and cars, and that narrative isn't going to change. And so far, policymakers in Beijing have not come through with a comprehensive package that many would say is needed to boost the consumer and resolve the real estate crisis.
But for that reason, reason of continued weakness, does that limit then the read-through that you're seeing into Europe if that kind of dynamic already exists?
Well, you don't get the catalytic effect of a rebounding Chinese economy and consumer. That's going to come at some point, arguably, but for now, you don't have that impulse when it comes to the consumer of China.
But then pile on the EV story or the EV tariffs, for example, as well.
Yeah, exactly. We're not even touching the sides when it comes to the tariff story, and that's not even bringing us up to November, when, of course, whoever wins is going to take a more robust approach to China.
Let's talk about what comes up for the rest of the day. Let's figure out what's going on. We're not done with the PMI data. Let me assure you of that. Eurozone data are about to drop. We'll get that at 9 o'clock London time, 9:30. You get UK data. So the PMI story absolutely front and centre. We get US data a little bit later on. ISM obviously mainly the focus over in the States. The big event this afternoon, triple witching in the United States. Look out for a little bit of volatility. Maybe this afternoon in markets.
Around the open, around the close, during those liquidity windows, So 4 p.m. New York, which is, what's that math?
4 + 5, 9.
Thank you. I'm struggling. 9 p.m. UK, 10 p.m. on the continent.
Yeah, it's going to be, so it could be an interesting close, interesting end to the week.
Yeah.
How much actually comes through, I think, is going to be really telling, I think, in terms of kind of where this market is in terms of the confidence that this market has. Do you roll on? What do you do? Do you roll off in terms of some of these options? I think it's going to be busy. I don't think this isn't a retail story. This is a institutional trader story that I think is going to be really
Every single person we
interesting.
talk about says clients are asking why we're not more invested in tech. There is a real optimism and momentum and liquidity story around this, all to the upside. But when the party keeps going, everyone's got to ask, when does the party
$100
stop?
billion off the market cap of Nvidia yesterday, but in the context, of course, of the run-up, it's small price. But we'll see if that is just a bit of profit taking yesterday on Nvidia.
So the pulse is up next. We'll walk you through all the PMI data. I'm on deck today. We'll bring you that next. That's what markets look like this morning. Thanks for watching. Have a great weekend. This is Bloomberg.